Hello and welcome to another episode of Global Business Insights. This is Bode Oshosami. Today we have a special guest, Soji Elias, an expert on global markets and chief counsel at Greyhorse Financial Corporation. He comments on how more African economies can take advantage of global finance opportunities. And we also have senior business analyst Lekon Shote, who looks at the tax reform bills, the latest on those bills in Nigeria. But first, the main headlines. India's Prime Minister Narendra Modi and Nigeria's President Bola Tinubu met yesterday to renew the strategic partnership between two major nations of Asia and Africa. India is a major trading partner for Nigeria, with bilateral trade reaching $7.89 billion in 2023 and 2024. In his last major speech before the Bank of Japan's December 18th to 19th meeting, the governor, Kazuo Ueda, cautioned the timing of the central bank's next policy adjustment will depend on the economy and prices, keeping options open over when to next hike rates. Wall Street indexes are cautiously higher in pre-markets as the Trump rally cooled off. Analysts are back to focusing on renewed inflation worries and uncertainty over the impact of the president-elect's policies. The S&P 500 last week erased most gains from a post-election surge, fueled in part by optimism over Trump's pro-growth policies. Gold rebounded today after suffering its worst weekly drop since 2021 as the US dollar eased and traders weighed chances of Federal Reserve rate cuts. Resolute Mining will pay the Malian government $160 million to resolve a tax and customs levies dispute that led to the detention of its chief executive in Mali. Today, the Anglo-Australian gold miners signed a memorandum of understanding to settle claims, also making an initial payment of $80 million. President Tinubu and Prime Minister Modi are strengthening Nigeria's and India's ties further during bilateral discussions and have exchanged signed memoranda of understanding MOUs to enhance collaboration in critical sectors. This is a very important connection for both countries. India is one of the fastest growing large economies in the world, has the appetite to consume much more Nigerian goods, thus expanding trade beyond oil products. Collaboration in manufacturing, technology, education, and poverty eradication are also very promising possibilities. Nigeria said it had secured nearly $14 billion of pledges from Indian investors on the sidelines of the G20 summit last year. This included Jindal Steel and Power commitments to pump $3 billion into Nigeria's steel sector. Also, as China-US trade tensions look set to spike, economies like Malaysia, India, and Vietnam are offering alternatives for businesses seeking a foothold in the Southeast Asian economic region. Beyond possibilities in working closer with fast-growing emerging economies like India, Africa and developing economies can do more to improve integration in global markets. Of late, more interest in Eurobonds have been seen as developed economies normalize rates and yields from emerging markets and African Eurobonds, all these becoming much more compelling. Soji Elias is an expert on global markets and chief counsel at Greyhorse Financial Corporation, and he comments on how African economies can take advantage of global finance opportunities.
They've pretty much always been there. At least it often looks that way, and they always will. They serve the interests of the willing and able, and in particular the ready. They are currently all about democratized access, transparency, and so forth, so that it is certainly, without any doubt, a matter for market entrants, market operators to ready themselves, as nobody else will do that for them, save and except the markets themselves, in accordance with how they are structured. Now, with reference to the vast majority of African markets, and all the deficits and challenges of market depth and so forth, market sophistication and so forth, that can make them relevant, or perhaps more relevant than they may or may not currently be. It is certainly the case that these markets have been described as emerging or pre-emerging markets for quite some time. Not many are up to the grade of emerging markets yet. There are all sorts of reasons, some might say good reasons even, for that scenario, but the markets wait for no one. We need to stop wondering how it is that global markets are relevant to local economies in Africa, because they are. They are part of a juggernaut. They need not necessarily be the ghetto of the global financial system, such as they may be at this time. Participation tends to hinge on matters like diaspora remittances and things of that nature, financial inclusion and so forth. The scope can be ampler. For example, fabled Nigerian Eurobonds are a particularly attractive instrument in those markets. And they certainly could enable the aforesaid pair of points that tend to characterize the participation of Africa's economies. But the message I want to pass on is actually a much narrower one, albeit one that has significant import. And the message is perhaps not that far removed from the standing message for structural adjustment from the International Monetary Fund from time to time. As I say, it is about the readiness of these economies and the responsibility taken by the economies themselves or their operators to ensure that readiness. Invariably, it is a matter of policy, a matter of economic preparedness, a matter of economic planning, strategy, and so forth, which is to say that it's a matter of expenditure. These economies have to ready themselves on a longer term footing for their plug-ins to the global financial markets. This will involve policy and its execution. It will involve education. It will involve reinforcing the infrastructures required to enable access to these markets. Now, those infrastructures include matters which will make each of these markets a lot more transparent. These are algorithm-led markets, these global financial markets, which means that the local markets must be able to proffer reliable data for the digest and result of those global financial markets. However far from the providing economies those global financial markets may be. Now, governments need to apply their best resources, the best efforts to enablement of their local economies, such that within specified timeframes, local economies receive the attention that they must have, with a view to positioning them for the advantages of global finance. Those advantages continue to proliferate and to multiply based on the tastes, based on the preferences, based on the attractions that are self-evident to these self-driven global financial markets. Local regulations have to be robust and they have to be good for export. The responsibility can't be placed anywhere else but firmly on the shoulders of the market makers at local levels.
Still on tax reform in Nigeria, it was reported that as uncertainty beclouds the fate of the proposed tax reform bills in the National Assembly, the committee is proposing a 50 million naira tax exemption for small and micro businesses in the country. Senior business analyst Lekon Shote, MD Publica, comments on the bills.
Recently, President Bola Tinubu sent 4 tax reform bills to Nigeria's National Assembly. The objectives of the bills are to reposition the economy for better productivity and efficiency, and to create more conducive environment for business and investments. If the proposals are accepted by the National Assembly, 11 tax laws will be eliminated, while another 13 will be significantly amended. Some of the new provisions are already causing some controversies. Nigeria's Northern Governors Forum has objected to some aspects of the proposed laws, though some pressure groups, like the hitherto unknown Arewa think tank, endorse the changes. Removal of VAT on certain consumer items like food, medicine, education, transportation, and removal of personal income tax for persons earning less than 800,000 naira annually are widely accepted. This should help the poor to cope with the recent removal of fuel subsidies, though the proposals have raised the tax rates of high net worth individuals who are not exactly happy with the changes. But the planned gradual increase of VAT to 10% in 2025, 12.5% between 2026 and 2029, and 15% from 2030 upwards worries everyone. It takes back what was given to the people as tax breaks. The argument that VAT is as high as 19.5% in some other African countries does not assuage the feelings of Nigerians. VAT, as you know, is an indirect tax that will eventually be borne by the citizens. While the proposal to pay more of VAT proceeds to states and local governments is welcome, the plan to raise the proportion paid to states from where more tax is derived from 20% to 60% is not exactly accepted, especially in northern Nigeria. While some observers perceive that the proposed sharing formula will favor states in southern Nigeria with regards to certain commodities like alcohol and luxury items, others think it should favor the north that consumes more of other products. Because even prominent Nigerian citizens, including a senator who was chief whip of the Senate, have openly raised objections to this and other aspects of the proposed tax amendments. The government may have to engage the citizens to explain the why-fors and the advantages in a more extensive manner. The government may also have to make amendments to the proposals wherever they are found to be necessary. In all, I think some of the reforms are long overdue, and tax administration should benefit from the streamlining and revocation of from taxes, structures, and processes that cause multiple taxation and anxiety for Nigerians.
Asian markets are mixed, struggling for direction after U.S. stocks fell to their worst loss since election day. Japan's Nikkei 225 index dropped as the yen regained some strength against the U.S. dollar after the central bank governor Kazuo Ueda indicated that the Bank of Japan will continue to raise interest rates as conditions permit. Equities in China and Hong Kong initially picked up after last week's sell-off as traders reassessed the outlook for further stimulus, but later the rally lost steam. Well, that's all we have on this episode of Global Business Insights. This is Bode Oshosami. Thanks for sharing, and thank you so very much for watching. Don't forget to send your comments. Bye-bye.